Hello friends, welcome back to another awesome day. Day 43 of the 100 Days of Hell with Python Algotrading. If it's not on paper, it's vapor. So it's my humble request to all of you guys, please start taking notes. Because if you don't write, it will be gone from your mind within 48 hours. And I'm sure that you must know about the concept of memory retention. So please, if you're not free, then don't watch this video right now. Whenever you are available, whenever you are completely focused, then only watch the video and please start making notes. It will really help you a lot once we have completed the 100 days. So as we discussed in the previous video that we are going to start the famous book of Sheldon Nettenberg's Option Volatility and Pricing. So guys, you must have heard that this book is one of the most important book for the quant interviews. Or even if you are a trader, it will help you a lot. It will give you a deep insight in the options. We will understand every topic of this book with real life examples. So it will really help you a lot. And if you only cover this 100 days content, you will not need to refer any other material. You can buy this book from anywhere. It can be an audiobook, it can be a PDF, or it can be a physical book. But please buy this book. It is really important. You can find the link in the description. And again, this is not sponsored, but it is recommended. It is highly recommended. And again, you don't need to be jack of all trades. You have to be master of one, because it will not help you to understand multiple things partially. You have to be excellent or you have to be perfect at one thing, and that is options. It will really help you a lot. So please focus for the next few days and we will understand everything in deep. So without further ado, let's get started. So we start with the first chapter, that is financial contracts, in which we'll learn about the buying and selling. We'll learn about the notional value of forward contracts. And we will also learn about the settlement procedures and market integrity. Let's first understand what are financial contracts. These are legally binding agreements between two or more parties which specify terms of financial transaction. And now the financial transaction can involve exchange of money, can involve exchange of goods, can involve exchange of services, or it can also involve the exchange of other financial assets. For example, you take a home loan from a bank and the bank gives you a lot of forms in which you have to sign. Those are the financial contracts in which everything is predefined, predetermined, that when you will be giving the money back, how much you will be giving, in which period you will be giving, the interest rate and everything. And those contracts are legally binding. If you do not follow that, you might have to go to court. So what are financial contracts? I write in pointers. These are legally binding agreements, right, between two or more parties, correct? And these specify the terms of transaction. You can say terms of financial transaction, correct? I'll write TX for the transaction. What are the things which are in the financial transaction, right? It can be a exchange of money, right? It can be an exchange of goods, right? Or services, or there are multiple other financial assets. Now, let's take a few examples. So in example, you can have, let's say, a home loan. You can have a car loan, right? Or you can also have, let's say, a phone plan, right? So in Singapore, we have to sign a contract with the telecom companies that it will be for 1 year, and that is the amount and all the conditions, right? And sometimes when we terminate the contract earlier, we have to pay some penalties. So these are basically financial contracts. Don't worry about the things. We will start from the basic, from the scratch, from the very beginner level. And you will see that after a few days, everything is clear. I'm not rushing into anything. I'm trying to explain you everything like I'm teaching to some kids, because I know the importance of the basics, the importance of fundamentals. So please understand all these concepts thoroughly, and it will really help you when you are going to explain in your interviews or when you're going to explain to any other person. You have to have a clarity of every concept. One more thing, What we will do, we will cover the remaining concepts of statistics and probability in this session, because it will involve good level of mathematics, and we have to have the good understanding of all the concepts of statistics and probability, because without them it will be very difficult for you to understand the remaining part, right? So don't worry, if you're a beginner, I will teach all those concepts along the way, right? So you can just follow along with me and make notes, try to solve the multiple choice questions which are given in the description, and also please try to solve all the tasks on the GitHub along with the mini project. Now we have buying and selling, right? So let's understand this. So what is buying and selling? It is involving the exchange of goods or services for money, the simplest term, right? So now what is buying? Buying involves acquiring something from someone in exchange for money, while selling involves giving something in exchange for money, the simplest term, and that is the only definition. Now let me write it quickly. So when we talk about buying, we can say acquiring something, right? Acquiring, and selling involves giving something, the simplest, and both in the exchange of money, right? You can say exchange of goods and services for money, correct? So what are the examples of buying and selling? You must have seen every day, right? You are doing everyday buying and selling, like online shopping, stock market, buying foods and drinks. So everything is buying and selling, right? So let me write it quickly. Few examples. So examples are, the first and the foremost is stock market, right? Online shopping, you are buying foods and drinks in exchange of money. Okay, now let's move to the next topic, which is notional value of a forward contract. So first of all, we have to understand that what is a forward contract. So let me write it here. Forward contract. Okay. So we have to understand this with the help of a live example. Let's say I was booking a flight from Singapore to Udaipur, and on the booking website, I saw an option of lock the current price. Let's say the current price was 60K, and there is a possibility that it might get increased or decreased in future. But I want this price, the current price. So what I can do, I can just give a small amount, let's say 1K, and the price will be locked for me in future. So I can book in 24 hours or 48 hours. So I can lock the price for a specified time with a specified money. So what is happening here? There are two terms, right? The first one is the cash, or you can say the cash transaction. So what is cash? Let's say I see the price, I book the ticket, and they will be taking me from Singapore to Udaipur. This is their service. They are exchanging the flying service, and to acquire that service, I am giving them money. So when I directly book the ticket, it is known as the cash transaction. Similarly, what happens in a forward contract? So I'm just trying to relate it with a real life example. So in forward contract, what can happen? I want to book this ticket at the same price, but in next 24 hours. So for that, what I can do, I can just lock the price in 1000 rupees, and then I can book the ticket in next 24 hours. Means there is a contract happening between the airline company and me. It is only for 24 hours, and I have to give a small amount in exchange of that service, right? So that is a simple forward contract. Now the next topic is notional value of a forward contract. So before understanding the forward contract, we have to understand what are options. As the name suggests, that we are buying an option from any exchange. Let's again take the example of the airline ticket. So what is happening here, that in the next 24 hours, I have the right, or I have the option to buy your ticket, or if I see that any other airline company is giving me the cheaper ticket, I can buy that. For example, let's say the ticket is for $1,000 from Singapore to Udaipur, right? And I am giving a locking price of $10 so that I can book the ticket in next 24 hours. Correct? So here I am buying an option, means I have the right, not the obligation. So what will happen if I buy or if I do not buy? So let's say if I buy the ticket within 24 hours, I can fly easily without any problem, right? Means I have the right. But if I do not buy the ticket, then I can buy from some other company and I can lose this $10. So that's a simple analogy from the options. And you can consider this $10 as the premium, the option to buy. So here two things are important to understand, that I'm not talking about the call or put, I'm just the option buyer. It can be anything, right? For now, option buyer means I have the right, or you can say option to buy the ticket within 24 hours, right? Or it's not an obligation, right? I'll write it. It's not an obligation. And also to buy this right or the option, I have to pay some amount, and you can consider that as the premium, right? And one more thing, that there is a specified time. There is a time limit of everything. So here we have 24 hours to buy the tickets. That's it. The simple things, because we are building from the base, the brick by brick. So just understand it, nothing else. Just keep your mind open. And if you are able to understand, please let me know in the comments that it is okay, or you want any kind of improvements. Now, when we talk about the option seller, so here we can say that the airline company is the option seller, correct? So I'll write here option seller. So what is happening here? The option seller or the airline company in this case has obligation to give me the ticket. Means they are obligated to sell me the ticket. Let's say there are multiple people who want to buy the ticket, but still they are obligated to give me the ticket. Regardless of the price increase or decrease, now I have the option and they are obligated to give me the ticket, right? In any case. Again, same thing applies here, that if I do not buy the ticket, they are in profit of $10 and that ticket can be sold to any other one. And even that seat can be left empty. That's none of my concern. Means they are earning the premium, they are taking more risk, and they are flying the aeroplane with the empty seat. So that was the basic analogy of an option buyer, an option seller. Now let's understand few more things. So I'll take again the example of same airline ticket, and let's twist this or tweak this little bit so we can understand more about the call and put option. So when we talk about the options, there are two things we can do with the options, right? We can either buy the option or we can also sell the options. Now, you must be thinking that this is the normal stock, because we can buy a stock or we can sell a stock, but where are the options here? So what I will tell you, that here what we did, we bought the airline ticket and the airline company sold the airline ticket. Means here the asset that what we are buying and selling, we can say the airline ticket. So the underlying asset here is airline ticket. So I'll write it as the ticket. This is the underlying asset, right? Means we can buy and we can sell the ticket. But here we are buying and selling the option. And what are the options? What can happen with the ticket? The ticket price may go up or the ticket price may go down. So I will write here the options. What are the two options here? The options are the ticket price may go up or down. Now what we'll do, let's say we are booking the tickets on booking.com, right? And we are booking for Singapore Airlines, right? So now me and my friend both are buying the option. I'm buying a call option, means I'm thinking that the price might increase, but my friend is buying a put option, means he is bearish. He is thinking that the price will be reduced. Means here we both are the option buyers. I'm the call option buyer and he is the put option buyer. And the booking.com is the option sellers. They are selling the option. Hope until it's clear. We both are buyers, the option buyers. I am buying a call option and he is buying a put option, because I am bullish and he is bearish. Now, if you are able to understand this concept, this simple ticketing concept, then congratulations. You have learned a big concept, a very confusing concept in the option market, because all the beginners make this mistake and they always get confused in these simple terminologies. Okay, now let's understand few more things. Now, what are the possible outcomes? Okay, let's understand them one by one. So me and my friend, let's say my name is Kuldeep, and my friend is Sandeep. Correct? We both bought the options. I bought the call option and he bought the put option, right? So I'll write it here. Kuldeep bought the call option and Sandeep bought the put option. Correct? Why? Because I am bullish and he is bearish. Okay, now what can happen in this scenario? Okay, first thing, what will happen? Let's say the current price of ticket is $1,000. I'll write it here. Current price is $1,000. I bought the call option, means I am bearish, and to buy these options I have given little bit amount. Let's say we both have given some amount. Let's say we gave $10, right, to just buy the option. Now if price increases, let's say from 1,000 the price gets 2,000. Now as we already have a contract with the company that I'll buy this ticket in 24 hours in $1,000, but after 24 hours the price is $2,000, but as we have the contract I can still buy this ticket in 1,000. And now my friend Sandeep bought the put option, means he told that I'll buy the same ticket which was that time 1,000. He bought an option to buy the same ticket in $500 after 24 hours. Now we both have the option, means we both have the rights to buy the ticket within 24 hours, right? And for that we have gave the premium, that small amount, that is $10. Okay, but now the price is $2,000, right? So what I'll do, I can buy two tickets. So I'll buy one for myself and one for my friend, and he can give me $1,000, right? Means I have the benefit of $1,000. But if we both buy separately, I buy my ticket in 1,000 and my friend have to buy in 2,000, right? Means he will be having a loss of $1,000 and including the premium, that is $10. As we both have the option, so my friend will refuse the ticket and he will not buy. Instead I'll buy two tickets and I'll give him one. So that is the condition for us. Means even if the price increases a lot from 1,000 to 10,000, we still have the option to buy or not buy. But in case of the option seller, they are in loss because they have the potential to reach unlimited losses, and the option buyer have the potential to reach unlimited profits, the benefits. So this was the basic analogy. It was just a simple starting, the beginner's example. We will have a lot more real life examples in the future. You have to make notes, because if it's not on paper, it's vapor, right? So now let's understand the notional value of the forward contract, right? The second topic, notional value of a forward contract. Now let's understand what is the notional value of a forward contract. So let's say I bought a call option from the airline company for the 24 hours, and I told them that I will buy one ticket in the next 24 hours at the rate of $1,000. Means Kuldeep can say that the notional value of this contract is $1,000. Similarly, let's say Kuldeep and Sandeep, Kuldeep bought that he will buy the ticket within 24 hours, he will buy two tickets, right? Similarly, Sandeep bought a put option, he will buy two tickets within 24 hours at the rate of 500 if it reaches. Means the notional value of the Kuldeep's contract with the airline company is $2,000. Similarly, the notional value of the Sandeep's contract with the airline company is $1,000. So this was the simple explanation of the notional value of a forward contract. Now let's understand the definition. So the notional value of a forward contract is the total value of the underlying asset specified in the contract. We can find the total value by multiplying the number of units of the asset to the current value. And how we can calculate the total price? We can multiply the number of units of the asset to the agreed upon price, right? So here when we see the number of units is 2 and the agreed upon price is 1,000. So it will become the $2,000. Similarly, for the Sandeep, the number of units are 2 and the agreed upon price is 500. So it will become $1,000, the notional value, I hope it's very clear, it's very easy. And if you have any doubt, please let me know in the comments. We can discuss this again in future videos. Now let's understand the settlement procedures. Okay, so what is settlement procedure? These are the process through which the terms and conditions of any financial contract fulfilled. So which are the terms and conditions? Let me write it. What is the settlement procedure? These are the processes through which the terms and conditions, so I can write it T and C, terms and conditions of any financial contracts are fulfilled. Okay, so it can involve the exchange of money, it can involve the exchange of securities, it can involve the exchange of stocks or any other asset. So in our example, what was the settlement procedure? When we bought the ticket, we have to transfer the amount to the airline company, right? So let's say I mentioned my credit card number and that amount will be debited and we will get a confirmation. And I transfer the money, they will transfer me the ticket on email or my phone. So this is the settlement procedure because we already had the condition that once I pay the money, you will pay me the tickets. Simple.